first event of the Finance Club. I'm sure you're interested in finance and investing, but there are also other ways to be involved with finance. For example, like me, I'm Jessica and I'm the head of marketing at the Finance Club, and I'm really glad to have you here tonight.
Thank you very much, Jesse. So first of all, thank you everybody of you for being here, especially to our guest. I know it takes a lot of time for you to come here. I know this is a sacrifice for you, and we are really blessed to have you here. So I want to introduce the guest for you. Rocio is director and wealth manager, and one of his superpowers is making people feel happy in just a few minutes. You will discover that in one moment. And Esteban is managing director and global investment specialist at Julius Bär, and he has like many different skills, but one of his superpowers is to wake up every day at 3 a.m.
Yes.
Unbelievable.
I will teach that superpower to you.
Yes. So I'm pretty sure that everybody of the Swiss people here know Julius Bär. For those who don't, Julius Bär is one of the most important private wealth management advisory bank in the whole world. They have been for more than 100 years in the market. They operate in more than 20 countries. They develop like tailored investment solutions for all of their clients. And just to show you what we are going to do in these talks, we want to discover, like in our finance club, in our research, we are understanding very well the companies, and we want to discover the modes of the companies, what makes special the companies, learn about strategy, innovation, and how to invest. After we understand the companies, we want to learn how to invest. Basically with that, I want to start with you. You kindly send us like some slides, so we will start understanding what portfolio management is, and then we will start doing like some questions that we prepare for you.
Super. Thank you very much, Felipe. And I'm sure the presentation, you'll control it, right? Or who will?
Yes.
Thank you. Shall I? Perfect. Excellent. But before I start, again, I just want to thank you guys for the opportunity. For me, it's a privilege. Definitely no sacrifice. I would come as many times as you invite me. This is a privilege, and of course, speaking with you is the highlight of my week. What I want is for you to interrupt me as many times as you need, as you want. The purpose of this is for you to learn. And I'm sure you are thinking you are going to learn something about finance. But what I'm here to do is to teach you basically to bake a cake. And to bake a cake, of course, we need to know three things. First, we need to know about the ingredients in the cake. You can be dreaming of the most delicious chocolate cake, but of course, if you don't know the ingredients that you will use to bake that cake, the rest is basically useless. That's the first step. The second step is you can have the best ingredients in the world. The Swiss chocolate, the Swiss milk, the sugar from I don't know where, the flour from the most prestigious place. But if you don't know how to combine those ingredients, there will be no cake, or whatever you bake is going to be awful. And then finally, I'm going to speak about the kind of mistakes that we do when we bake a cake. We might know the ingredients, we might know how to combine them. Yes, but we might take the cake out of the oven too soon, or we might leave it there for too long. And why? Because someone told us that should be the way, and we are going to speak about that. So basically, as I said, I'm going to teach you how to bake a cake, but of course we're going to do that with some financial terms. And here you have a very interesting slide, which is no other thing than a very simple map with the asset classes, with the cake ingredients. And you can see that map is divided between risk and complexity. So if you go to the low left-hand side part, you can see the easiest to understand, less risky asset classes. And then if you go to the upper side, right-hand side, then you end up with the most complicated, with the riskiest, and again, the trickiest asset classes. But there you have a very simple map of the cake ingredients. And of course, uh, just speaking about this is part of a training education that we give to our clients in the bank. And just to speak about this, Rocio and I take probably 6 or 7 hours, because we go in depth to explain what each of those ingredients is really about. But for us today, and I want just to speak about this 5 minutes, for us today, what I want you to have in mind is precisely the map, the names. And if someone tells you, let's invest in stocks, or let's invest in bonds, or let's invest in ETFs, that you already have this map in your mind and you say, okay, what this person is speaking about is something that's not so risky, not so complex. Or if someone comes and says, you know what, I have the best idea for you, it is a futures, a derivatives, an option product, or a structured product, or for example, a private equity that that is on the right hand side, top side of the chart, and that means complexity and risk. But basically, when you think of the asset classes, stocks, bonds, and many other things, think about a contract that you are signing with someone else. So let me give you an example. If you buy a bond to invest, what you are really doing is you are actually lending your money for someone to use that money for other purposes. And that other person, that other company, that other government who sells you that bond is going to promise you two things. First, to return that money to you at some point, and second, to give you some sort of a price, and that price is the interest rate. So bonds, you can see clearly, it is a contract for you to lend money and then get it back with some reward. Stocks are the same thing. Actually, I don't know if in your classes you have been able to see stocks, at least on a book, how they looked alike, and they were papers, pieces of paper that said, instead of saying, Felipe is lending money to Sprüngli, which would be the case for a bond, in that case, the paper would say, Felipe is owner of Sprüngli for 0.1% of the company. That's it. So when you are buying a stock, what you are buying is a little piece of that company. If you buy a stock of Tesla, you are part owners of Tesla, as Elon Musk is. However, he has plenty more stocks than you, But that's it. So it is really a piece of paper, and what you need to know is precisely what you are getting into. If you buy a bond, what you want is for that company that you are lending the money to be able to pay you the money back with your interest. If you buy a stock, what you want is for that company to make as much money as possible because you have a little piece of that business. If you buy an ETF or a mutual fund, what you are buying is a piece of a basket. Imagine the typical basket that people used to have or still have to go to the supermarket. So they have the basket and they put inside fruits, for example. That's an ETF. That's a mutual fund. It is a basket, but instead of fruit or vegetable, it has stocks or bonds. So if you buy an ETF or a mutual fund, you're buying a little piece of that basket. And now probably you are asking yourself, but what's the difference between a mutual fund and an ETF? Very simple. A mutual fund is managed by someone, a team of people that are deciding what to put in that basket and when. So of course, if that group of people are good at doing that, you should expect to make money. So that's a mutual fund. And an ETF has no people. An ETF is basically, let's call it an algorithm, a computer, trying to replicate or copy what an index is doing. For example, the Standard & Poor's 500, or for example, a bond index. So it is only mirroring or copying whatever the index is doing. So of course, when you buy an ETF, what you are looking is probably for something cheap to replicate something, an index. And when you buy a mutual fund, you want to buy the strategy of the best team doing precisely the choosing of stocks and bonds in the basket. Then if you go towards the upper side of that chart, you will go into the territory of derivatives. I'm sure you already have had some experience or learning about derivatives. Derivatives were originally meant to be used to hedge risks, but now, of course, they are used to make money by having a very tiny investment, which is called a margin. So a very small investment with a very big potential profit. It sounds great, no? Who doesn't want to have a very small investment and then suddenly have a big profit? Yes, but then there is the other side. You can have also very big losses. So derivatives are the kind of stories you hear of people that became rich from one day to another, no? But also from one day to another, they lost the house, the dog, the family, and everything. Because if you don't use those derivatives as you should, your losses are potentially unlimited. But anyway, these are the ingredients of our cake. And again, we could go in much detail speaking about them. Now I want you to see this chart, and don't worry, I don't want you to read whatever is on that chart because not even I have read that. What I know is on that chart is basically each color represents an asset class. So each color represents, for example, bonds, another color represents stocks, another color represents ETFs, mutual funds, private equity. And what I want you to see, and of course, each column represents a year. What I want you to see is precisely what you're probably thinking. What a mess. What a mess. This chart shows you that in any given year, the asset class that performs the best, which is on top, and the asset class that performs the worst, is not going to be the same asset class that performed the best or the worst in the previous year. So you don't see all the blue squares on top or all the green squares on the bottom. You see them scattered all around the chart. And that only tells you that asset classes don't perform in the same way every year. Some years they perform well, some years they don't perform well. And this chart should serve for you to realize that if suddenly someone tells you, you know, if you buy stocks of whatever company, it can never go wrong, no? Or if you buy bonds, you can never lose. That's not true. This chart shows you precisely that there are no written rules, that asset classes move all around, and what works in one year doesn't work in another year. So the problem that we have in our hands is how to combine all those things to make a tasty cake, to make a portfolio that performs well, that gives you money, and that doesn't give you an ulcer because it's going up and down every year. So what I want to present now to you is, in a very summarized way, let's call it investment strategy that we follow at Julius Bär. So look at the top part of this chart, and there you can see, let's call it an assembly line. Imagine a car assembly line, no? And an assembly line which is very simple, only 4 steps. In the investment process of Julius Bär, and Rocio will speak more in detail about Julius Bär, but bear in mind that this is a private bank that has been able to survive for more than a century. So something good is being done in the bank. The investment strategy is really summarized in 4 big steps. So let's speak about the first one. The first one is basically what you are doing today in school. The first one, let's call it research. In the first step, we, the investment committee in the bank, we get together and we speak about the markets. How are the economies performing? What do we expect about inflation? what do we expect about corporate earnings? Are they going to be good, bad, or not? What shall we expect about Mr. Trump and the trade war? No, is he going to really do what he's promising or not? So it's this analysis that takes, I can tell you, probably 10 hours of the week just to get everybody together and come up with a standardized way of thinking, with a way of thinking that we all agree on. And of course, to do that, the bank has analysts all around the world. I don't know the number anymore precisely, but I think it's around 200 people that we have all around the world just doing that. We have experts following economists basically. We have experts following industries. So we have people that only know about IT, that only know about construction, real estate. And then we have experts in asset classes, people that only know about equities, stocks, people that only know about bonds, and like that, all the way until we get to, for example, people that choose and pick the best stocks to have in a portfolio. Those are the typical analysts that you've probably heard about. So they have to write research reports, they have to do company valuations, bond valuations, stock valuations. They have to come up with a recommendation: buy Amazon, sell whatever name you have in mind. No, they need to come up with a target price, which means, okay, if I buy Amazon, what is the price that I should expect in the next 12 months? And the analyst needs to do all those numbers. No, but not only that, Julius Bär also has access to analysts and experts in other banks. So in our investment committee, we also take into account what other analysts and other banks are saying about certain topics. So you can imagine that discussion about what we believe the economy will do, the markets will do, the stocks, the bonds will do, becomes a very interesting conversation when we have all these Julius Bär experts contributing, plus the experts from other banks. So in the end, what we want to do is, again, to come up with a story that we all in the investment committee feel makes sense. We like the US, we like Switzerland, we don't like Brazil, we don't like another story. We like IT, but we believe it's expensive. We like, for example, the industrial and manufacturing sectors, but we don't like. So this is the kind of story that we want to really agree on, so that we can go to the next step. And the next step is called strategic asset allocation. This step is responsible for 90% of the performance of a portfolio in the long term. So if there is one step that needs to be done correctly, is this one. So what is this step? This step is actually deciding how much of the ingredients in our cake we will have to combine, we will have in our portfolio. How much of the portfolio will be represented by stocks? How much of the portfolio will be represented by bonds? So of course the portfolio is 100%. How much of that portfolio should we allocate to stocks? How much should we allocate to bonds? How much should we keep in cash? How much should we put in gold? No, imagine those questions. And if I were to ask you, I'm sure all of you would have a different number in mind. No, I would put 60% of my portfolio in stocks, 40% in bonds. Someone else would say 80, 90, 10. In reality, some banks have let's say, a very relaxed way of coming up with these numbers. So some banks follow this 60-40 rule: 60% equities, 40% bonds. That's it. But not Julius Bär. Julius Bär follows a very quantitative way of coming up with these numbers. And I don't want to cause nightmares to you and bore you to death, but this means regressions. No, there is all these statistical methodologies that you've learned in school. So linear regressions. Let's use the prices of all the assets in history, and let's see how these prices have behaved in relation to each other. No, what has done a portfolio? What has a portfolio done if it had 50% stocks and 50% bonds? So we run those linear regressions and we come up with a number. Well, that portfolio should have had a return of 20%. What if that portfolio had 60% stocks, 40% bonds? We do the exercise again, and then we realize it was not 10%, but 12%. But imagine like that with each and every possible combination. Not 50-50 and 60-40, but 50-50, 50-50, 59-41, 58-42, all the combinations that you can imagine. And of course, for that, we need computers. But in the end, we come up with a number. So if you were to ask me, okay, what is today this strategic asset allocation that Julius Bär recommends, for example, for a balanced portfolio, I would say something like 53% in equities, 43% in bonds, 10% in cash, and 4% in gold. So those numbers, you cannot come up with them. Those are really the result of a computer making all these combinations and saying that combination is the one that, based on history numbers, would have given you the best overall result. So this is the most important part of the investment process.
Excuse me, but
Yeah.
the one that you just mentioned, Stefan, is changing every time because it's considering not only the numbers in regression per se,
Yeah.
but also like when exactly, what is going on in the market,
Yes.
all the things that you mentioned at the beginning of the macroeconomics, like how are we going to move those allocations on a monthly basis, every 3 months, or what happened if there's a Ukraine or other events outside. Should we also consider that?
That's an excellent question because actually, and we didn't prepare that, guys, that's the next step.
Mhm.
So the next step is called tactical asset allocation. So in other words, the computer says the best combination of assets, I'm going to say something like 53% stocks, 43% bonds. Okay, that's what the computer says. But we in the committee, we know that the computer doesn't know that Mr. Trump is making a mess of international trade, or that Russia and Ukraine could finally come with an agreement. No, all those kind of things a computer doesn't know. So for that, you need people with the sensitivity to say, you know what? I think the current scenario could be riskier than what the computer is assuming. And therefore, let's not have 53% in stocks, let's have 50% in stocks. Or the other way around. The computer doesn't know that, I'm thinking out loud, that Russia and Ukraine will finally reach a peace deal. Let's go not to 53, but to 55. No? So for that, you need people with a sensitivity, as Rocio said, and this is a constant exercise that we do at the bank, at least once a week, if not more. Finally, in terms of the process, we have the portfolio construction. So once we say, okay, let's have the portfolio constructed in this way, we need to choose. Are we going to do this with individual stocks, with individual bonds, with mutual funds, with ETFs? How are we going to construct that portfolio? Which are going to be the vehicles for that? Because for our clients, that can be a real game changer. Some of those vehicles, you have to bear a lot of taxes, for example. For some of those vehicles, not, because they reinvest the money. So we have to choose the vehicle. Now, this is my last slide. Everything goes perfect. You understand the ingredients. You combine them perfectly, but there is a problem. We all are humans. That's the problem. And our brains work in a way that sometimes is not really aligned with maximizing our profits. So let me give you an example. And here we go into the territory of behavioral finance. Traditional finance, as you know, operates with some assumptions that might not be real. For example, in traditional finance, one of the assumptions is that we as investors are rational, that we operate with all the information that's available. But you know it's not the case. So this side of finance, behavioral finance, studies basically how we take investment decisions when our brains are dominating the process. And let me give you an example. I will just mention a couple of them. So, for example, loss aversion. I don't know if I ask you, no? Imagine I give you $1 million today and you lose that $1 million tomorrow. Will it hurt? I'm sure it will hurt a lot. No, losing that $1 million will hurt. But let's now imagine that tomorrow I go to your house and tell you, I have a gift for you, $1 million. So you suddenly realize that you won $1 million. What do you think in terms of intensity is more? The pain of losing the $1 million or the happiness of winning $1 million? In reality, it is the pain. And you know why? And this has to do with how, again, we humans have evolved. When hundreds of thousands of years ago, we humans lived in a cave, and you gathered all the food and suddenly lost that food, you were dead, basically. So we still today have a lot more sensitivity to losing than the sensitivity that we have to winning. And that, in terms of finance, means that if you buy today a Tesla stock for 100 and tomorrow you wake up and it is worth 90, you are already losing. Would you sell that stock tomorrow? No. I saw already a head moving no. But then 2 days later, you find out that the stock price is 80. Would you sell that stock at 80? Of course, no. I have to wait for that to go back to 100. So that, again, that pain of taking losses makes us as investors take bad decisions, because probably we should have sold that stock before we do. And the same thing with our gains. With our gains, we buy at 100 and tomorrow you wake up and it's already 120. We tend to sell because we're already happy we won 20. But what about if you had waited a little bit, maybe it went to 150? So those are the kind of behavioral biases that we need to deal with. And for that, I think, again, the benefit of having a bank that suddenly takes the decisions for you or that guides you throughout of the process is very valuable, because you need someone to discuss this kind of decisions, and for someone to tell you, you know what, you are not being rational.
Thank you for this very nice introduction. I wrote plenty of questions just about that. But before going back to like this financial analysis, I just want to connect this with one question that I was preparing for you, Rocio. You manage clients around the world, and with this in mind, what's like the biggest threat you have to handle? Like, how you manage this behavior in some of your investors that maybe sometimes they don't have like a background in finance and they don't understand what's going on. How you manage your clients when maybe they are losing money, because I'm pretty sure that they don't earn every day more money. Sometimes they have to lose. So how you manage that with your customers?
Well, thank you for your invitation, Felipe. Thanks for having us today. First of all, we would like to say, in wealth management, in the bank that we work for, normally there is different type of profiles, different type of clients, families, we call them. Julius Bär families. And primary, the group that is the main one are the family entrepreneurs, okay? Those entrepreneurs, as you mentioned exactly, they're very well versed in every single topic that you can imagine in their industry. You sit down with these people they have superpowers, they have this energy, non-stop energy for creating and for taking risks in a way that you have ever seen nowhere. I mean, you have never seen this before. So they are wow people. But if you sit down and you would like to tell them, let's talk about investments in the capital markets, they don't know anything about it. They probably don't understand the topics that we just heard from Esteban. Of course, they know about that. But do you think that they will know when to go into the market, when to sell, what to buy? Of course, no, they don't. And they are used to control everything. I mean, they are the president of the board of companies that they make revenues on an annual basis, millions of dollars. They are superpower people, and they know how to control. They control every single detail at their business, not at their house, probably somebody else with that house, but yes, for sure, in their business. So, do you think it's easy for them to say, here, this is the money, the liquidity that I have from these dividends from this quarter, do it whatever you want to do it with that? No, they don't want to deal with uncertainty. They don't want to deal with things that they don't manage and they control. So if you put in from 1 to 5, being 1 the less riskier and 5 the highest, they would love to be in the number 2. First of all, don't put me in this mountain high and down roller coaster. No, I just would like to be there. If there's volatility, the valuation of my portfolio every single day changes, I don't want to see different type of volatility above 10%, not even 5 sometimes. So you have to deal with that type of client, and that's not easy at all, because you can talk about any topic with them, and they have to be in control. On this one, that you have to completely understand, and the sensitivity. You need to have the sensibility to understand why they are like this, where do they come from, and what is in the stage they are currently. I mean, are they always going to be making decisions, or they are going to trust in you because I know you come from Zurich, that is a reliable country, and City from Switzerland, a reliable country, or because you come from the top of the world private bank, and they do this for more than a century, and because you seem to be a reliable person. You know, those 3 topics are important, of course, but you have to feel if they are going to test. How are you going to be making the decisions for them? Because they just sign all these papers and they think and they rely on you that you are going to make the best decisions every single day for them. And we have in the whole experience that we can have with different type of entrepreneurs in different type of industries, different type of stories, that they sign papers with you and they would like to see how they perform, how this person, and at the beginning sometimes they tell you, well, here's the signature, here's the money, $40 billion, $50 million, so you can invest it right away. And Esteban was saying, at the end, the implementation phase, how important is the implementation? They already gave us the key to us as a wealth management to put and invest the 100% of the whole wealth that they give into construct the portfolio. But if you don't have the sensibility again to understand all the goals, then if they're going to live with the volatility, if they're going to live not making decisions, and you are going to make the decisions for him, you better don't try to skip the details on making a super well structured, disciplined way of doing the construction of the portfolio. Even though, for example, at the beginning of the year, we were sitting with Esteban talking about how the market is going to see the 2025, the market assumptions this year. The bank knows at the beginning, with all the research around the world, of course, they don't know, they just put this hypothesis and these market assumptions outside. All the banks does the same process. But we have to, and we knew from the beginning that we're going to have volatility. Now we have the money, we have plenty of cash sitting there. So what are we going to do? Are we going to start investing? For example, if you decide to invest the whole amount of money that your clients gave you at the beginning of January this year, probably now you are going to have 10% less of the capital you invested. If you didn't have the sensibility to listen all the signals from your client and all the market assumptions that you have to deal with. And you have the instruments, the tools, of course, but that's your decision. It's so difficult to get the trust from these people, from their families, is you better deliver correctly, because they don't want to see any penny that you are not taking care of. So that's why we have to be on top every single day on how to make the decisions. So I don't know if I answered your question, but
perfectly. And like connecting that again, we like the market and how to invest. I will go again to start with the process. So you have 200 analysts around the world in different topics. Then you merge like all this knowledge. Then you go to a meeting board. I think you are 11 members in the investment committee. And then you decide what will be the best for the whole bank. And then when you know like all the ingredients for your cake, you start building portfolios for everybody. Is that true? Yes?
Correct, yes.
So my first question with this is, how do you decide how to believe in the company? Why? Like, how do you take a decision with 200 different minds? How you discern and how do you say, okay, this makes sense, that doesn't make sense? How you measure, like, for example, if somebody in the board meeting is like more powerful and know better how to speak,
Yes.
how do you pay attention not to this guy but the guy that maybe have a better investment theory and not this guy? Because sound like really complex to like make big decisions with so many heads in mind. How you process all this information before, like,
Of course,
before my next question?
it's very simple. No, so we have, in terms of the committee, we have voting members and we have non-voting members. So a lot of people are invited to the committee. They can present ideas, but in the end, the the decision lies on a very strict and small number of people that need to vote. And of course, that takes care of too many voices and too many opinions. In the end, 11 people will have to vote. And if 5 say yes, 5 say no, there is one that has a voting power to really skew the decision to one side or another.
And you don't think that maybe 11 people still a lot of people to take decision? I don't know, like I think when you are in a big group and you have 11 people, if some maybe some people is not so committed, because like if something goes wrong, they can blame the other 10. They can say, yeah, maybe I was not so sure. So it's not so many people to take investment decisions.
It's a great point because suddenly you might have too many people there and no accountability, basically. But in reality, when you take a look at who are these 11 people, then you have a very good sense of the as Rocio would say, the power that each of them bring. So we have a head of research, we have the head of investments, we have the head of risks, we have the head of trading. No, so each one of them has its own superpower, and of course, when there is a decision, some decisions might fall more into the research guy, some decisions might fall more into the risks guy, and that's how it works. But in the end, it needs to work like that with votes, because then otherwise you have too many voices and all of them need to be heard.
Okay, I received a very good question from the public, and somebody's asking, yeah, I think connecting the dots, you told me that you use a lot of regression models, a lot of like math to predict what the future will be. And does the bank build a bank strategy with decision making using like psychological knowledge theories? Do you use psychology as well to tailor like these investment decisions, or it's just about numbers?
Definitely yes, no, and this, it sounds very mystical, no, the psychological elements. Uh, I can summarize it with one word. It's called momentum. No, there are different metrics that measure momentum, and momentum is basically that. The momentum of the stock going up has to do with psychology, with people buying that stock because they believe it's going to go up. No, and yes, our models have momentum, and they have a lot of other metrics that are measuring that pulse of the market. And of course, when you combine that with the quantitative elements, you have the best combination.
Yeah, good point. I think it's really complex to understand how you do all these decisions. But okay, for example, another question would be, and maybe we'll start making questions with the public, but how you measure success when you do like all these investment like strategies, like because for sure you don't compare yourself just with the S&P 500 just to check if you outperform them. But like, what's your rationale to say this is a good investment? We did it great. Like, how you measure the success of these strategies?
Well, let me first give you how we do it, and then Rocio probably can add what the investors believe is a successful strategy. No, because we might measure that success relative to something else. For example, we have an equity strategy which invests in U.S. equities, and the way we measure if it was successful or not is by looking at, for example, the Standard and Poor's 500 index and seeing if our performance was better than that. No? If it was better, we won. If it was lower than the S&P 500, we didn't do our jobs. But of course, Rocio has that sensitivity because we might say, yes, we are great. No, we are beating the market, we are beating the indexes all the time. But the clients might think differently, right?
Correct. Yesterday I had a presentation with a client that is going to, for the first time, do a complete different strategy. And I presented great numbers, two-digit numbers with next generation tendencies that we have, strategies behind, special value. All those three combined make great numbers, above 18% performance per year. So you might think, well, definitely he's going to turn, leaving 6 point per annum and a performance, and to switch into that one because that's a successful situation. But no, because what is successful for you is not successful for him and not successful for her. It's very personal. If the goal for this person is to have 6.7 and be or 3 points on top of inflation, and that's his goal, that's success for him. Or probably no, because I know my we always say there is the opportunity. What would I make what would I do with this money if I put it somewhere else? If I am an entrepreneur and I know if I put this money in as something else that it will give me 10%, and I know for them no at all risk. Of course, we know there's no such investment without risk, but for him, no risk, 10%. If I put it here with you, Rocio, are you going to give me the same 10%? So probably it's completely up to them to discuss or to decide what is successful. But our professional way of putting the options to the client, the client at the end, he decided not to go with the 18% new strategy combination with at all, even though we are saying there is this 95 possibilities to give you this type of return on this particular with a long horizon, investment horizon. He was like, no, I want to sleep well. I don't want to have the roller coaster again. I don't want to deal with the problems about the tariffs and all these things and the macroeconomics, really all the things. I just want to like to have my 6.7, Rocio. Thank you.
Do you want to make a question? And then
Yes, I have a question. So let us go back to just a second. So to tactical asset allocation. So you use the forecasting, the future by humans with reasoning. And we know these days that large language models also can reason. So do you think there will become a time that we use large language models instead of humans to reason? Because what are machines able to do, humans are not able to do, or they can work 24 hours, so they don't have to sleep, and they can reason all night long, and they can do it, millions of them can do it simultaneously. So do you think the next 5 or 10 years there will be a change in tactical asset allocation for Julius Bär?
Definitely, yes. It's happening as we speak. Actually, Julius Bär already developed its own AI model, no? And Rocio and I use it, and our portfolio managers use it, and not only for tactical asset allocation, but also for strategic asset allocation, and also for the research part, no? Imagine a computer filtering all this information that is arriving from news sources and deciding which is really important and which not. However, and I'm going to leave you homework, sorry for that. However, in the end, we need humans. And let me tell you why. Because, I don't know, well, all of you have used ChatGPT, no? What does ChatGPT say at the bottom? Results might be wrong, no? Results might be wrong because it is basing all of its answers on past information. And yes, with past information, you can make predictions. But if something doesn't work precisely as it worked in the past, the prediction will be wrong. So my homework to you is to read, if you can, a little bit of a company that used to exist like 30 years ago called Long-Term Capital Management. Long-Term Capital Management was founded by all these people that you know, Nobel Prize winners, the ones that derived the financial theories that you have to study in school. They got together, imagine 3, 4, 5 of these PhDs, Nobel Prize winners in finance, get together. They found a company to make money in the financial markets. Who can beat them? No, it's like having a team full of Messis and Ronaldos. Who can beat them? Well, the company went bust and almost took the entire financial system down. So read about it. And it was based on algorithms and computers.
Yeah, I really like that you talk about that, because something we are learning now actually is like to understand like some core fundamentals that will never change, and that some like big investors have discovered during his career.
Yeah.
Because seems like sometimes it's not just about having the best resources, have just the best brains, have the best models, but it's about how to think and how to discern. So, with that in mind, I have two questions. First is during your whole career, because by the way, he is CFA shareholder, he has worked in banks around the whole world. You did a master in finance. Like in your personal investment portfolio, how have you choose your personal stocks? Like which patterns have you find that are constantly during all the time? Maybe connecting this with yeah, like the intelligent investor. How you use your reasoning to like I don't know to be emotional while picking stocks. Like what are the patterns that never change?
Yeah, of course. And in the end, I want Rocio to speak about time in the markets because this is something that she always reinforces to clients. But uh, and again, I can tell you this here as friends. You can study as much as you want. You can learn all these models by heart. You can have pictures of all these people in your room and almost worship them. But in the end, you need to be you need to think logically when you make investment decisions. If suddenly something sounds too good, if suddenly something sounds strange, if suddenly something you don't understand, which is, for example, my case now with cryptocurrencies, I don't understand. I'm sorry. No, I don't know why they go up and they go down. And of course, every time that I see that they go up, they go up, they go up, I think I don't feel very well with myself. No, but you need to be logical. You need to be um, aligned with what you want, with the risk that you want to take, and very simple rules. No, we were speaking about Warren Buffett at the beginning, but his investment style in at its core is very simple. No, do a lot of research, feel comfortable with the company, make that investment, and stay there. But not for 1 month or 3 months. Stay there for 30 years. No? Well, that's basically time, no, in the markets here.
Yeah, and I would like to ask you first, just to complete the idea Esteban was asking. First, who from this room has been or has with an investment with his cell phone? Who made an investment? One, okay. We can say the majority. Nowadays, young people make investments like this very easily. And I would make the question then to you, the same question you did to him. What is your analysis behind to make a decision to buy, for example, let's go to NVIDIA or sell NVIDIA. What happened with ChatGPT and DeepSeek? It's time to sell NVIDIA. What did you do?
Actually, like I'm young, I'm starting in this world, so I don't know so much. But for me, like I think we have to develop like a philosophy about how to invest, because I think if you invest in everything, it's really hard to be good at something. So, for example, and something related to what we studied that is value investing is to choose value that go through different like generations and some pillars that never change. So, for example, personally, I will never invest like in companies like Nvidia, Tesla, or crypto, because I think they don't have like a real values, more like noise from the market and a lot of like newspaper. Like obviously there is people making money there, but I think that's very risky because you cannot forecast like what will happen with that. Uh, but for example, there are like some companies that Warren Buffett had invested, such as like Sea Candies, American Express, Apple, that they have like a principle, and it's that the customers are really like stable, and they have built such a big brand that even if Trump says something, if the market like crash, like Coke could be the perfect example. Like it doesn't matter what happened outside, the company will still survive and
Well,
will be still important.
that
So that's what we are trying to look here, like to learn how to think about the companies, because
Yeah.
it's really hard.
So that's exactly the point. The point is to don't just go with the trends because everyone goes there. Study the fundamentals. What you are trying to explain with those words is why are we going to go with this specific company? Why they have the finance, the solid balances, they have debt behind. What is their know-how? How are their barriers of the how to be strong or compete against the different type of scenarios that they have to encounter in the market, in the real market. So you have to understand if you are giving the money to a company, if I would be a company, you have to know, well, Rocio has to know what is the governance, what the type of decisions she is making to drive the people to the next phase. So all those studies, that's exactly the fundamentals of the company that you have to make the decision of. So, and then just to complete the sentence is stay invested, even though you have fear, you like to make the decisions basically on things that are the behavioral finance. Try to stay away, and if you cannot, trust in somebody professional that will do the homework. We've seen people that are CFA, Master of the Universe in finance, and they make super wrong decisions because they did not make the homework to go into professionals and to, of course, read the little single letters when you sign a contract.
Okay, perfect for this question.
Sorry, just a second. I wanted to say something.
Yeah, okay. Let's ask another, and yeah.
So last week I did a trade on Microsoft because I saw they went so low and it seems so irrational that they are going down and down and down, although the metrics are perfectly fine. So that's very irrational, and for me that's a sign and a point to invest, isn't it?
Perfect. No,
Right.
no, exactly. That's it. You made a logical decision, not the one based on fear, because one based on fear would be it's falling, don't get in there, no?
And then I thought about NVIDIA, and it's also rational to invest in NVIDIA because everybody needs those graphic cards, right? But nobody knew that around the corner a hedge fund is waiting to release a new model, and they shorted NVIDIA, and that's crazy. So you cannot anticipate such things. That's unbelievable. Yeah, that's what I wanted to say about.
Aligned to your point, last week, for example, there is this particular segment of the companies in the U.S. that we call the small and medium companies. Okay, so small and medium companies, they still have to pay a lot of money to get the debt. If they would like to have loans, they have to pay a lot of money that they didn't have to pay and didn't have to absorb. For how many years the companies are nowadays in the US experimenting to pay 5 more or 3 more, 3 times whatever they used to pay for the money, for the loans? More than 2 years. So we were expecting to have those to raise at some point, but it's not happening. So you would say, okay, then are these companies going to go into default soon? Or should I expect to buy the ETF that are the Russell 200 to just because I think they are going to have the possibility to go up? So you have to understand what is the rationale, again, to your point, behind if these companies are good enough or they have problems with the liquidity, they have other type of problems, and you don't want to go into decisions without information on what is going on with this type of specifics, okay?
So, because we are running a bit out of time, like I prepared many questions about like the bank, like how to think better. But I think to start closing, I want to tell you all, because like this is a space as well for students, that Steban is not just a managing director at Julius Bär, but he's as well a life coach. He has a certification, and that was like something that made me feel confident about the talk today, because I knew that you were going to be like a very open guy. He has as well his social media channel. You can follow him. But with this in mind, and reading one of your books, he's an author as well. You talk about that many times usually we self-impose our barriers to grow. Students sometimes are like scared about where path to do, how to grow. So my next question is, what, I don't know, I have many questions, sorry, but what do you think is the best way for students to use their free time? Is one. And if you have like the chance to go back to the university back again, what would you do different?
Sure. Thank you for the question. So, in terms of how you make the best use of your free time, honestly, I think you are living a moment, and I know this is the same, the kind of thing that old people always say, no? But you are living the best moment in your lives. I can guarantee you, because you have in front of yourself your future, but you also have the opportunity to learn in an environment that is made for that. So my suggestion would be, try to learn as much as you can from the things that you like. No, it doesn't have to be finance. It doesn't have to be things from school. But try to learn. Try to relate to people. That's now. Let me go quickly into the topic. One thing that I didn't do very well when I was younger, and still today I don't do very well, is networking. If you have the chance to do that, I think it's going to play in your favor. No, not because you will have someone to ask a favor in the future. No, but because you can learn from them. You can grow. No, and again, in the future, you don't know how those relationships can work for you. So try to learn as much as possible. Try to network, and try to have fun. And most of all, and this is not only for now, but also for your future career as professionals, my suggestion would be, remain authentic. Remain authentic, which means be yourself. If you don't like drinking, if you don't like, I don't know what, never do it. Never compromise on those things. Not for the best job in the world. Never. Because if you stop being yourself, if you lose that authenticity, I can guarantee you it will kill your spirit at some point. So remain authentic, and the doors will open. You don't have to become someone else to work in a bank or in an IT company or in whatever you want to work. That would be my suggestion.
And also, I would like to add, be generous, because you're right now, you are being generous of being here, sharing, learning, getting together, and not doing and staying at home or being in the social media. So go out and do whatever you're doing. So congrats for being here.
Thank you, thank you. And yeah, by the way, this is a really good place to network. So we hope to see you on our future sessions, because we really want to learn, yeah, a lot of like professionals. Yeah, maybe does somebody here have like any other questions, something you want to ask? I know Sophie is really interested in women in finance always. You want to make a question, Sophie?
Yes. What was your motivation going in this men-dominated field? What was? Are you just following your passion and going with it, or was there another factor that was for you?
Thank you for your question. Giving, that's the answer. whenever, it doesn't matter if you are in finance or some another sector, if you feel that you have things to give, the way you can do it, just go and follow it and make the most of it and enjoy, as was saying Esteban. I enjoy being with people around. I enjoy giving my time to others to try to accompany, or how do you say it, share the times that are sometimes difficult for them to go through. And being a wealth management person or advisor is being along with the families, along with people. Is not only with finance. Finance is just a tool, is the instrument. So I spend a lot of time with people, with the families, talking about different topics about life. I am a mother of 3 boys that I feel so proud. One is here, and I call him meine Größte. So those life experiences is part of my lifestyle whenever I'm sitting with this family in the other part of the world, because they're humans as well, and they have their own family problems. And believe me, one of the most difficult situations to have a wealth transfer is to have one simple thing that they lack, is communication. They lack the time to sit down and to say, this is the way we would like to have things done whenever I'm not going to be here. And that is so difficult for super wealthy families. And being us as a team, because we make team approach, it's not just me at all. We always go together with Esteban and also with other members of the team, that they have the different type of specialities. And one of the topics is making everything, the first point is to understand what are the main of the goals and the values of the family, because the main goal is to keep the family united. And since I have my own family, I try to exactly develop the same thing that I do at home in my job. So it's part of the women to be there, definitely. Or not, Sophie?
Yes, I heard a talk 2 days ago said that you should hire the divas because the divas bring something to the workplace. And that was a very interesting message for myself, because I was in some other project, some political project, and I was pushing for me because this is like my value to do it right. And now I'm very happy to have the great team that is also motivated to do something. And one second question, what have you done for your work-life balance? Because I know the finance job is very disciplined and you work 10 hours a day or something like that.
And just, but by the way, Esteban in his book have just one chapter to talk about balance. So I think they are the ones to ask the question for.
Please go ahead.
Esteban is a master of that particular topic. But personally, I have a person at home that is, I always call him my CEO. That's my husband. That's my partner, that who helps me to have my balance. If we wouldn't company of 2 on making things happen with our family, it's difficult sometimes, because you get so focused that you have to deliver. Today you have to deliver whatever you need to deliver in your job. I mean, and you can stay forever. I mean, it happened to me one day, more than one day. I was like, oh my God, I didn't go to sleep. And well, that happened once. And there was my CEO saying, oh, you are with the same clothes. You didn't sleep. That happened many years ago. So, and that was one of my learning, that we are not here to do that. We are not supposed to stress ourselves and to put our health in danger. not for any type of work of a job at all. So you are here to be to live fully and not to stress yourself like this. So first, have a discipline, have a always try to stand up at the same time and try to put your alerts to leave the office and have time with your family. And then if I am not done, I didn't finish my job, whenever they are sleeping, I go back and get my laptop and finish whatever I need to finish. But I try to not miss the birthdays of my kids. I have to be there for the big, we always say dates, and my anniversary, for example, and things like this, and have always personal life as well. That's it.
And very quickly, balance, we sometimes think of balance as, okay, the day has 24 hours, I need to do 12 hours one thing and 12 hours the other thing. No, balance is a little bit a game of averages. You might have to work, as Rocio was saying, very hard 3 days in a row, but then make sure you have another 2 or 3 later on to do the things you want, to pay attention. Sometimes you need to spend those 3 days working. Sometimes Rocio has to travel sometimes 2, 3 weeks in a row, you know. She couldn't say I travel one day, but one day no, one day yes, one day no. So it's a game of averages, but be very strict in terms of those averages, because it's very easy to forget about that. We were speaking about working, for example, for consulting firms, for investment banks, and yes, you can leave your life on the table, and in reality, nobody will care. You need to be mindful of you, of your family, of your values, again, of the things you want, and balance in the long term.
So I will just do the last question, and we need to close because our guests need to take a train quite soon. But just connecting all the points, as I told you at the beginning, our goal here is to understand like the value of the companies. We couldn't talk too much about the bank. Maybe
Yeah.
probably in the future we will talk about that. But the value is not something that is just in companies. As we were talking right now, value is something deeper. There is like value in families, in relationships. And my last question for you is, what's the most valuable thing for you in the whole life? What's the value of life?
For me, it is very simple. No, for me, it's my family. That's something I wouldn't compromise for anything in the world. Not for a job, not for money, not for success. And as Rocio was saying, this is my bottom line in terms of what I'm willing to put on the table. No, if what I'm putting on the table is going to affect my family, it's off. It's over. What about you?
The same as I mentioned previously. Yes.
So first build a family, then start investing. Thank you very much, everybody, for being here.
Yeah.
Thank you very much again for
Thank
being
you.
our
Thank
guest.
you,
We
guys.
enjoy a
It's a
lot this
pleasure.
space. It's a real pleasure to have you here.
Ours.
And yeah, hope you can be with us on our next session.
Thank you.